BlackRock's flagship private credit fund is honoring less than 40% of redemption requests. That means when people tried to get their money out, they got rejected 60% of the time. That's not a glitch, that's a feature. And it tells you everything about what's actually happening inside the $3 trillion private credit market. So here's the thing. Private credit was sold as the safe alternative. Banks tighten lending, these funds step in. They own corporate debt, equipment leases, infrastructure deals, boring stuff. Supposedly low risk, your financial advisor probably recommended it. Mine definitely did. The pitch is always the same: diversification, higher yields, less volatile than stocks. What they don't lead with is the fine print. The gates, the liquidity locks, the part where if everyone tries to leave at once, the door gets much smaller. The market is roughly $3 trillion, maybe more. It's hard to know because most of it isn't traded on public exchanges. That's kind of the whole point. These are private deals, illiquid by design. The funds that manage this money are supposed to maintain enough liquid reserves to handle redemptions. Handle is the key word there, not guarantee. Handle. When markets get nervous, redemptions spike. People want out. And when the gates close, they're stuck. Meet Kevin flagged this exact dynamic on his channel recently, and institutional research from MUFG and UBS both say the same thing. This is a real liquidity problem, hiding inside what looks like a stable asset class. Here's where this gets personal. If you're invested in a balanced portfolio right now, there's probably private credit in there, through a fund, through a mandate, through something your advisor calls a multi-strategy allocation. The yields are high, like 5, 6, 7% higher than treasuries. That spread is payment for illiquidity. You're getting paid to not have access to your own money. And most people don't realize that's the trade they're making. Now, the market doesn't crash every day, and the funds that manage this stuff are professionals. They probably won't all blow up. But the question isn't whether they blow up. The question is what happens when they're forced to sell good assets at bad prices because they need cash. Because they promise liquidity they don't have. When one fund does that, it puts pressure on the next fund. That's contagion. That's systemic risk. The Fed isn't really worried about private credit yet. Congress isn't looking at it. The rating agencies still say it's fine. But the institutional crowd, MUFG, UBS, Meet Kevin, they're all pointing at the same thing. 60% redemption denial rates aren't a signal that everything's fine. They're a signal that the plumbing is getting stressed. And here's the part that really matters. When this breaks, it won't be because private credit funds are inherently bad at underwriting. It'll be because they made promises about liquidity that they can't keep during a drawdown. And when you can't get money out of an asset class, two things happen. Either you wait and hope, or you start bidding down the underlying assets to force a sale. The second one is worse. So what do you do if you're sitting in private credit right now? Check your documents, read the fine print, understand the gate policy, know what side pockets are. That's the term they use for assets they can't sell, so they lock them away. If your fund has those, that's not a good sign. And honestly, if you can't access your money, you probably shouldn't own it. That's not diversification. That's a trap wearing a yield. The $3 trillion market is probably going to be fine. Most of it is fine right now. But the fact that BlackRock's flagging 40% redemption rates means they're already stressed. And if they're stressed, smaller funds are definitely stressed. This is the part of the system nobody's really looking at. And that's usually where the problems hide. So here's the question. Are you actually comfortable with your money being locked in an asset class that can gate your redemptions? Or did your advisor just move you in there because the yield looked good? Drop a comment, because honestly, I think most people have no idea what their actual redemption policy is, and that's kind of the whole problem. If you want more deep dives on the parts of the financial system that are quietly broken, the stuff your advisor doesn't mention in meetings, stick around. This is the kind of second-order risk that doesn't get talked about until it's too late. And speaking of people being really good at hiding what they're actually doing, a guy in Maryland bought 3 identical lottery tickets and won $150,000. Same numbers, 3 times. The actual odds of that working out the way he planned are astronomically low, which raises the obvious question, Is buying the same ticket multiple times a strategy or just an expensive ritual? Asking for a friend. All right, if this kind of second-order thinking is useful to you, stick around. More coming later.